Prashant Tripathy, the MD and CEO for Max Life Insurance Company, joins us on the show right now. Prashant, hi, morning. Recently New York Life has picked up about 2% stake in Max Financial. This shows New York Life signaling renewed interest in the insurance business. Do you see New York Life garnering further share or a strategic stake?
Hi, good morning. This is just a reiteration of the good work that Max Life Insurance is doing, and I don't think they are going to pick up stakes further. This is just a small stake that they have picked up, but it is a reflection of a partner who was our promoter for a very long time to come back and take a minor stake in the company. It is a reflection of the continued interest in our entity, as well as the reiteration of the trust that they have in the management team to execute the strategy.
Right. Surely enough, I, however, want to take that story forward. You're at the helm of Max Financial. Would there be any change in the strategy going ahead? What will be your key focus areas over the course of the next 2 years?
Yeah, that's a very good question. Actually, Max Life Insurance has done very well in last 3 years. As we finish the 9 months of the year, we are growing about 20%. We are very happy with the overall performance. I think the industry is also doing very well. If you look at the total industry performance for the first 9 months of the year, it's a double-digit growth, and it comes on a very high base. As you know, after the demonetization, the industry grew quite rapidly for a couple of years. On that large base, also the industry continues to grow. And as I look at my role, I think the strategy that we adopted last year, which was around focusing on building our own channels, trying to make sure that we have good product penetration, especially around protection, and making sure that all the good things that we do around customers just continue. So it will be perhaps reprioritizing, looking at them more sharply, making sure that the journey that we have embarked on with respect to growth of our own channels get further push. So, there are 2 or 3 areas that we are trying to really look at. Grow the proportion of our own channels in the total mix, and we are hoping that in 2 to 3 years' time we will reach about 40%. Equally, the focus on strengthening our partnership, a very valued partnership with our bank partners, will continue to remain in focus. We have been digitizing in a big way. I think that will continue to get focus across all the touch points of customers, sales process, our distributors, and our employees, so that will continue to be there. Customer has been a good story for us. All the measures with respect to customers, Max Life has always done well. Very, very proud that the recently published reports that came from IRDA, we are #1 on the claims paid ratio, which is a big achievement. We are ahead of all the players. Equally, the focus on improving persistency, looking at long-term persistency, managing surrenders, and trying to work on improving the net promoter scores with respect to customers will be focus areas. So in 2 to 3 years' time, if we do a fantastic job with respect to building our own channels across the customer measures and digitizing the organization along with managing our key relationships, that will be a good thing for our organization to happen.
That's exactly what I want to stretch about as well. If you could tell me and get a little more specific and candid here, tell me, how is it that you foresee the industry grow for the next 2 years? And within that framework, what is it that we can expect in terms of growth for Max?
I feel very positive about where the industry is. It went through some difficult time because of regulatory changes that happened between 2010 to 2015. But 2016 onwards, the industry has done remarkably well. The growth has been very strong, double-digit growth, though the base increased, and this year we are seeing that for the first 9 months, the industry is about 11% growth on an adjusted, new sales basis, especially the regular ones. My sense is that it is going to revive. I already saw that happen in the month of December, where the industry grew about 15% on a much larger base. My view will be, if we were to outlook next couple of years, because of several elements, predominantly, with respect to the savings rates going up and formalization of savings, I would expect the industry to grow somewhere in the range of about 13 to 15%. Within that, Max Life, because of its focus on building our own channels as well as the franchise that we have, we would expect to grow somewhere in the range of about 18 to 20% most definitely.
Right. Can we see the core ROEV to improve greater than 18%? If so, what are the factors that would lead to the improvement? How do you see things shaping up on that front?
Actually, Max Life is a company which is quite focused around all the value measures also. And for us, it is very important to maintain a very healthy ROEV numbers. We embarked on a journey about two to 3 years ago with respect to coming to a 20-20-20 company, which means 20% value of new business growth, 20% margin and 20% ROEV. And very proud and happy to share that in 2018 itself, we achieved that milestone. So our ROEV numbers are upwards of 20%. We hope to maintain that. There'll be growth that is expected to come, and as we embarked on this expansion journey, our vision and our aspiration is to become a 25-25-25 company. So there is an expected lift in ROEV which will happen because of 2-3 reasons. Number one, change in product mix. We are trying to balance our product mix, which should give a rise in the margins. We are expanding our own channels, which should give fillip to our growth rate and hence the VNB numbers. And generally, ROEV is a result. If you're growing fast and your margins are good, you end up getting upwards of 20% ROEV. So because of those factors, we expect that ROEV will continue to lift. And as I mentioned to you, by FY22, about 3-4 years from now, we'll outlook or at least aspire to have a 25% current kind of ROEV numbers.
Also wanted to understand, how is it that you see the distribution mix in the product mix to change over the next 2 years?
For us, like I mentioned to you, we did try to balance our product mix in last few years, and currently we have little over 40% ULIPs, close to about little less than 60% traditional, but within traditional we have about 14 to 15% non-par and the balanced par portfolio. As we outlook and go further, we will desire to rebalance the product mix, and we will like to focus a bit more on protection and the guaranteed saving part also. So I'm hoping that in 2 to 3 years time, while the ULIP will remain between 40 to 45%, between the traditional mix we'll like to go upwards of about 20% on the, or 20 to 25% on the non-par and the balance on par. As a result of this, we are expecting that it will be a healthier product mix. The margins will get optimized, and we'll be able to serve the broader set of customers. With respect to distribution mix, as I mentioned to you, there is focus on building our own channels. So again, 2 to 3 years time, we will outlook to have closer to about 40% being done by our own channels. When I say own channels, it means through agency, through our direct workforce, and through internet and e-commerce, and the balance 60% through our partner channels.
Well, we wish you the very best for the future. Thanks very much for giving us so many details about the way ahead for the business. It's great that so much is changing and the transformation is underway.
Thank you very much.